Hello and welcome back to Simple Money, the show where we talk about personal finance issues that affect Canadians. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. Today, we explore an issue that I get asked all the time, and that's what's the deal with the new mortgage rules? So, to set the stage for the episode, federal regulators have been attempting to slow down the flaming hot growth of the housing market and the debt attached to it. On numerous occasions, the Bank of Canada has said that growing household debt and the rising housing market in select cities are the largest threats to the Canadian economy. To help reduce these risks, federal regulators have implemented a whole bunch of new rules and laws. The most recent change involves implementing a stress test on more borrowers. Previously, the stress test was only implemented on those that had a down payment that was under 20%. But this is sort of no more. First, though, we need to understand how the stress test actually works. So, in the good old days, and by good old days I mean just a couple years ago, a mortgage application would be tested against the interest rate that was agreed upon at the financial institution. They would essentially look at your household's net income, your debt, certain expenses, mortgage payments, and credit rating. Your mortgage application would then be sent down to an individual that would approve or decline your application, also known as an underwriter. The approval of your mortgage application would heavily rest on the interest rate that the financial institution was offering you. So now, the process is really quite similar, except for a couple big changes. So your mortgage is no longer tested at the contractual rate that would have been offered to you at the bank. It's now being compared to a model mortgage. This model mortgage is based on a Bank of Canada 5-year rate, or a rate that's 2% above what you receive at the bank. So to put this into perspective, you can find a 5-year fixed mortgage in Toronto for about 3.3 to 3.5% right now. As of today, the Bank of Canada's stress test rate is 5.34%. The approval of your application is based on the higher rate. This translates into you getting a mortgage that is a lot less as if it was based just on the bank's rate. In several cases, these new rules also apply to individuals that already have mortgages, specifically if they're doing a mortgage refinance or if they want to transfer their mortgage. However, simple mortgage refinances at your existing bank are not affected. So of course, what is government policy without unintended consequences and loopholes? And with these rules, there is a big loophole. These new rules only apply to federally regulated financial institutions and those financial institutions that voluntarily adopt the rules. Provincially regulated lenders, like credit unions and other alternative lenders, are not required to follow these new rules. So if these new rules have a heavy impact on you, you can simply just go to another financial institution that doesn't follow these rules and apply there. It's actually quite silly. And this is exactly what we've seen. There's been a massive migration of borrowers from the major banks to other lenders. And in response to this, some of the bigger banks are now starting to fight back by slashing certain mortgage interest rates. So for example, Bank of Montreal and TD recently cut their 5-year variable rate to 2.45%, which is really low. It's going to be really interesting to see how these new rules play out over time. It wouldn't surprise me if all financial lenders are eventually required to follow these new rules. That's it for now, but stop by next week where we explore how the interest rates that you think you're receiving are probably not what you're receiving. In the meanwhile, if you have any questions or concerns, you can email me at info@ffcoach.ca or find me on Twitter at F_F coach. Take care and see you in the digital world.